So you know how life is super busy and there's so many financial products and there's so many financial people, it's hard to make financial decisions? I'm Adam Gain, owner and financial coach of Gain Financial. We help families with businesses as a one point of contact to integrate, coordinate, and organize your whole financial economy so you can save time and energy and live the life you want to live. All right. Okay. So we've talked about the rules for prosperity, and we went over rule 2, like how to actually set up a savings process. So I'd like to jump into rule number 3 and have 6 months worth of income liquid at all times. And with this 6 months, we're looking at your total gross income. And I've got a sample model here. So this is somebody that we got a teacher and a chiropractor, but they're making a total of 250. And so in their case, 6 months, we would look for about 125 of liquidity all times. So let's get into that and see how this works. So the first question really is, well, why should I have 6 months? And what are the purposes of that? Really, the 6 months comes from allowing you to live your life. If both of you guys lost your jobs tomorrow, having $125,000 in the bank account or whatever 6 months is going to allow you to live your life probably for a year or two. First off, you're going to stop saving. You're not paying taxes, and you're probably going to cut some expenses. So it's that big purpose of having money there liquid and ready, and that'll allow you to get back on your feet, more or less. So that's the first purpose. I think most people know they should have money liquid at all times, and that's for the emergency fund, or what I call the economic issues that pop up in life. So that one's pretty simple. Then I get to the next ones where it's like, okay, well, that's the purpose, but what are these other 4? Right? The next one is, we don't really think about this, but we can actually increase our deductibles on all insurance. And this is also pertains to warranties. So if you have money in the bank or if you have access to money, then you typically don't need to go and get all those warranties because the chances of all of those things going wrong at once, it's very slim chances, right? So if you have that money, you're not as stressed to be able to purchase that thing. And then the deductibles, if we're looking at, for instance, your vehicle, your property insurance, a lot of people have their property insurance at $500 or $1,000. If you have money in the bank, you have liquidity of 6 months worth of your income, you could probably increase that deductible. Now, if you increase that deductible, what's going to happen to your premium?
It'll go down.
It's going to go down. So that's going to help us. That's going to help us accomplish maximum protection at minimum cost.
Yeah.
Right? So by having that liquidity, it's giving that extra cash flow. That make sense?
So you pay less on your insurance.
Yeah. We can save costs and have the same coverage. Yeah, because we have liquidity. The next one is it's going to reduce our risk on all investments. So how can liquidity reduce risk? What do you guys think?
There's like a margin call or something, like if you have to come up with money in your investment?
That's perfect. So for a stock, so 2 things have to happen for you to lose money in a stock. Number 1, it's got to go down. But you haven't lost money yet, right? Until you what?
Until you have to sell it. Right?
Until you sell it. But like you said, if there was a call on that stock, if you have liquidity, you can prop it up. You probably wouldn't want to put money in anyways, because it's probably at a really low. So then you might not have that loss. Or if we're looking at, for instance, like real estate properties or investing in pretty much any way, you want liquidity because things can happen and it's going to cost you way more if you didn't have that liquidity.
Right, because you'd have to borrow to pay for things. Is that the idea?
Or credit card, or like if you have access to the money, even at lower rates, but or a lot of times, like if you have to wait until the insurance money comes in and you're paying someone's hotel bill, you couldn't fix it right away. So now this hotel is going to cost you an extra 2 months because you have to wait for monies from somewhere else. The fourth thing is it allows us to take advantage of opportunities that pop up in life. You know, I find once you have money liquid and you have access to that money, opportunities will seek you out. And typically, I would say about 3 to 4 times throughout your life, there's going to be these big opportunities that come by and come across your path. And having this, you're going to be able to jump on it. Sometimes you need money in like a week, right? Does that make sense? Have you guys ever experienced that before?
The wind turbines.
That was
when we got an investment, and we had to have money right away, basically.
Yeah,
so we
exactly.
invested in some wind turbines that get like 11%, so it was great.
Awesome.
You can't always
Perfect
access
example.
like green type of energy investments, so it was a good opportunity.
Awesome.
Yeah.
And I like to point out too, opportunities don't have to be for your gain. You have the opportunity to help others if they are in need. You know, I had a lot of clients during the pandemic. They had friends that lost their jobs, and because they had liquidity, they were able to help their friends out. And they paid them back over time, or maybe it was a gift. But you have that advantage. And the last thing is just peace of mind. Right? Being able to sleep at night, knowing that anything that could happen in life could be thrown at you and you have something to fall back on. It's not ideal. It's going to affect your overall dreams in life because you're using your financial assets before you wanted to, but you still are okay. You still have a roof over your head and you're still going to be able to buy food.
Yeah.
So, any questions on the 5 purposes?
Makes sense to me.
Like how available are we talking? Like how liquid do you mean? Like it's got to be.
Yeah, that's a good question. So let's talk about the how. So that was the why. So why do we need it? And now let's say, like, how do we actually set up something for ourselves? And I don't want it just sitting under your mattress or in a bank account because it's not going to be doing much for us. We want this money moving. We want it to do more than one thing for us. So there's really 3 places in Canada we store this money. The biggest thing with liquidity is there's going to be 0 risk. Right? So you can't put it in stocks and bonds. You can't put it anywhere that it has risk because now it's not liquid. Because if something happens, you're not going to want to take it out. And anyone during the pandemic that had money in stocks, if they had to take it out the low to live, well, then they just lost that big gain that they came back, right? So, number 1 place is your WCA. Your wealth coordination account. We will always want a little bit in there. That's typically a bank account. And this right now, it's February 2023, and we're getting about 2.85% on this account. Not bad. It's just a normal checking savings account. It's got no fees and no transaction fees, and we got a decent interest rate. So we want some of the money there. The next spot is we can access money really early, like because a lot of people, you might look at that number of 6 months worth of income liquid, and that's like a lot, like 100,000 for a lot of people. It'll take a long time to save it. But if you have a house and you have equity in your house, if we can set up a home equity line of credit, you can get access to it right away, and we can satisfy this rule immediately. And this is going to save you 7.2%. That's what the rate in a typical home equity line of credit is. So it's not making you money, but it would save you if you did owe something on it. And so if I have $1 and I put it in my WCA, I can make 2.85%, or I have that $1 and I can put it on my line of credit and save 7.2%. Pay down the line of credit. Yeah. It's obviously that's more efficient, right? So when you save money, you're pretty much making that same rate. Or if I'm saving 7.2, then I would have to make 7.2 somewhere else tax-free for it to be equal. That make sense? Mm-hmm. Okay. Now, and sometimes using some ways, we can actually make your WCA, your home equity line of credit, and be super efficient, because then we can just have our savings save you money constantly. The last thing is, the last place in Canada is cash value life insurance, using a whole life policy. Now, the great thing about this, right now, you're probably around 5% tax-free that it's growing. But long term, if rates stay high, we're gonna see that increase over time. But the cash value is gonna give you all of these other benefits. It's gonna give you the death benefit that you might want to cover your family and all of these other things. But it's gonna grow for you forever, but you have first access to it. They can never not give you a loan if you have cash value in there. And they'll give you that loan with no questions. So it's 100% no risk.
And then we would get that on each of us. Like we would each have our own.
Possibly. It depends on different situations, and we help design what's appropriate and how that works. But if you have these three things, this is where we're looking at the 6 months. So in the example, we talked about 125 of liquid at all times. So when I'm looking at your model, we're going to look at making sure that out of all three of these places, you have at least 125. Now, if it's appropriate, once you get over the 125, we can look at doing more with it, using money to create money, if it's appropriate. Right now, 7.2%, not looking too great.
We got to find more than that to make it useful to use.
Yeah, and for the risk reward,
yeah.
Exactly. So like we can make 8%, but that's giving you 0.8%.
Yeah.
That doesn't make a lot of sense. Okay, any questions on liquidity?
Is there a ratio, like an ideal, like which one you should have more of or less of?
So we want the lion's share in your cash value because it's going to do the most things for you. And typically 5,000 to 10,000 in your WCA, depending on what's going on and how much income and how much liquidity you need. I would say like 5-10% of your total would be good in the WCA, and then if you have a home equity line of credit, or as much as we can in the cash value. Okay.
Yeah.
Sound good?
Sense. Yeah.
Okay, that's rule number 3. Thanks a lot for watching that video. Check out some of our other videos. Subscribe to our channel. Feel free to reach out anytime. We're looking to work with great people long term.